Hi, I'm Devin Zeidelman with Scheer Partners. There's been a lot of talk about the impacts of venture capital funding on core life science markets, and today we're going to unpack this for you a little bit further. Funding remains a key driver for scientific company expansions in the I-270 corridor. Investments in pre-revenue life science startups within the bioeconomy are inherently risky given the long payback periods associated with clinical trials, which can take upwards of 10 to 12 years before commercializing. Life science companies that took advantage of an accelerated funding environment during the pandemic years, especially firms that elected for bridge financing rather than raising a true seed round or Series A, are cutting back on overhead by reducing headcount or disposing of facilities that are not essential to research and development. Companies that are extending their cash runways due to the high burn rate associated with developing technology and, like owners of scientific real estate, have transitioned to a posture of risk management versus a strategy of pure risk avoidance if they can. Deal activity has come in the form of M&A or partnerships that can be attributed to transactions increasingly focused on real estate needs, not just technology. Although I forecast that this will lead to arbitrage within the sector, with larger, proven enterprises acquiring promising pre-revenue companies at wholesale values and bundling them under a single entity towards an eventual IPO. Venture funds are still raising capital, despite an overall narrative that funding has stopped and when the time is right, will make capital calls. From 2019 to 2021, there was an average of 135,000 square feet of in-market expansions, and since, there has been under 30,000. Within the current pipeline, our team is tracking 130 to 150,000 square feet of additional prospects. As a best case scenario, this would imply between 310 to 360,000 square feet worth of executed leases to round out the year, which is well below the historical market average of about 550,000 square feet. Despite muted tenant demand, the second half of the year has been more influential in terms of overall leasing activity for the corridor, and we would expect a handful of deals to close out the year as we prepare for 2024.